the Moneyweb Crypto Podcast, where we discuss all things crypto related. Your host, Kieran Ryan.
It's been identified as one of the biggest challenges in Africa, getting access to funding for building homes. Just 3% of people in Africa qualify for mortgage funding, meaning that virtually all homes are built with cash. This also explains why there's so many partially completed homes dotted across the continent, waiting for the next bit of cash to put on a roof or a door. The stats show that there is a backlog demand for about 50 million homes in Africa. Banks will not extend mortgage finance unless the borrower has a stable job. Now, in a continent where 80% of income is from the informal sector, clearly the banks are not going to solve this problem. Empower is a company that's set out to solve this puzzle using the blockchain. It connects investors, developers, and home buyers so that people in the informal sector can afford to build homes on a rent-to-own model. In Africa, where credit records are virtually non-existent and more than 80% of income is informal, a traditional mortgage is almost impossible to access for the vast majority of people. Empower has come up with an interesting way to collateralize mortgage lending using the Empower token, which is a digital representation of wealth. It's a marvelous way of unlocking funding for mortgage lending to potentially millions of people in Africa. Now, this is different to the normal banking lending model where clients are dragged to court when they are a few months behind on their payments. Clearly, that's not going to work if we're going to solve the housing problem in Africa. To discuss this, I'm delighted to welcome back to the podcast Glenn Jordan, CEO and co-founder of Empower. Hi, Glenn. It's good to talk to you again.
Hi, Kier.
It has been quite some time since we last spoke. Bring us up to date on some of the developments in Empower and how your projects are proceeding across the continent.
Yeah, thanks, Kieran. Yeah, since we last spoke, we have made significant progress. And I remember at the time we were kind of holding thumbs, you and I, and saying, we hope that this is a solution and we hope that this, can gain some traction. Well, I'm very pleased to report that it's gaining significant traction. When we started out, I had a meeting with some of the development institutions and, we told them we were developing on this technology. And their response was, we will never deal with you when you're building on this technology. So we will have nothing to do with you. Well, I'm very pleased to say 3 years later, that has fundamentally shifted. People are starting to understand that the blockchain is not crypto. The blockchain is a technology that is useful, particularly in this environment. It is not speculative. It's not, we so often confuse Bitcoin with the whole blockchain space. And they two are fundamentally different. Bitcoin is a one use case of blockchain. It's not blockchain. And the blockchain is a useful technology when we are seeking to create immutable financial data that monitors cash flows, which is effectively what housing is. To invest in housing, we need to monitor cash flows and provide mechanisms to provide reward for investing into those cash flows. And that's what Empower is doing. And that's what Empower is creating the ecosystem to support building it on this new and innovative technology.
I hope I gave a reasonable explanation of how Empower provides mortgage finance and how this differs from the traditional banks in my intro. But give us a quick overview of how you go about solving this problem, connecting investors and developers and providing housing to potentially millions of people. I know your target is to build 1 million homes by 2030. It's a huge target. How is that progressing?
So the numbers are slower than they were here hoped because of the distribution of capital, but the processes that we're building are enabling that to scale. So our hope is that we will actually be able to implement it on the hockey stick kind of basis, because as we prove it, we are demonstrating that this is viable and that this is achievable, to my earlier point, it strengthens the case at every stage. Because at the end of the day, we're actually competing against 100 years of data. Everybody knows and understands a mortgage. Everybody understands the processes. There's legal structures. Everything exists to support the mortgage. We've taken that in the developing world. We've taken that structure from the developed world and have tried to implement it. And in South Africa, that works brilliantly in the developed sector, the traditional white sector. It doesn't work in the township environment. And that's the point. And the rest of Africa is far more like the township environment than that infrastructure. So the question is how we address those issues. So to your point, you mentioned the self-build aspect of building. You drive anywhere across the continent or anywhere across the developing world, and you'll see partly built buildings, half-built park construction. And effectively what that is saving to build. So as you say, it's a pay-as-you-go mortgage, actually. That's what you're seeing there. And that's what we've created, is the ability to pay as you go rather than to have this fixed structure of a payment that a mortgage defines in a very structured environment. We expect 20 or 30 years of steady income. Now, in no environment does that exist anymore, not even in the developed world, but obviously there's more reliability. But even in the developed world, the gig economy is becoming far stronger and far more relevant as people get multiple jobs and work, varying kinds of hours. Income is no longer what it used to be. It's not a static thing that gets paid on the 25th of the month and you can do your debit order for your mortgage on the 26th. So the question is, how do we create mechanisms that enable that informal sector to pay on that kind of basis and then manage those payments back to the investor in such a way that you can create stability for them and understanding that this still provides return. And that's the key part around it. So it's around linking the two parts to meet the needs of both parties. And to that point, it's to meet the needs of the informal sector, those pay-as-you-go, self-build kind of payments, while on the other side, meeting the needs of capital, who's looking for steady income, steady understanding of what that looks like. So if you can think about it really as if you build for rental stock, which is obviously a big investment kind of portfolio, or you invest for sale, those are really the two ends of the spectrum. Really what we're trying to do is blend those two into a mechanism that enables investment into that space, but provides for the ownership to pass to people who can pay, but the challenge is that they earn intermittently and variably.
Let's talk about the risk side of things. I guess it's important to note you're funding housing development using market mechanisms. You're offering competitive rates of return to the investors. But you also allow investors to trade out of their positions, which means you've got to create a secondary market for this debt. Walk us through that process.
So that's one of the really interesting parts around the digitization and tokenization portion of what we're doing as well. So exactly as you say, we've got two. So we've talked a lot about the informal sector and meeting their needs. But to your point, it's around meeting capital needs. A lot of people do not want to be involved in property development, for example. And again, so across Africa, what we found is that finance for development is intermingled with finance for offtake because there are no mortgages. So what that means is a developer has to be a banker as well as a developer. So the skills required to do that, he can't develop do a development, sell it out as it would work in a functioning society, sell it out to people who are then going to buy them and then move on to the next development. He has to stay in the process while the people pay it off over time. And actually he uses the customer's funding often to fund his development because the banks won't give it to him. So we're trying to separate the two out to make sure that we are focused on the offtake financing. So in other words, it's removing the construction risk. The units have already been constructed. It's around providing a mechanism for them to be sold, in inverted commas. So what that does is that significantly reduces the risk because, again, it comes back to there is an asset. There's an existing asset which you're actually funding. So that significantly reduces the risk because that asset will generate an income. So, as I said, whether that is the rental stock or a sales stock in the functioning society, that would provide you that option. We're just combining the two. So the element is there is an asset. So you have an asset backing. Effectively, what we're doing is in the developed world, in the mortgage environment, The banks take those mortgages, package them up. I know this has got a bad rap from 2008, but it still happens, obviously. Package it up and securitize that and on-sell it. What we're doing is just effectively bringing that process forward. So instead of taking that process and having to put it through the bank, because the banks can't provide this kind of formal structuring, we're putting those cash flows into digital instruments, which are then tradable. So those digital instruments can be utilized for initial capital raising and secondary trading. Now, the important part around that is liquidity, as you say, is very important. I don't necessarily want to be invested for 20 years into one specific property development in Nairobi. But if I've got data on how that portfolio is performing, how those cash flows are coming, I have a pricing mechanism and I have liquidity. So I have up-to-date information on how that is performing. That makes it far more viable for me to trade in and out of, so I can increase the liquidity of this investment and I can increase the attraction of capital into the space, because it's not just about, we're never going to address that challenge that you outlined in your introduction. We're never going to address 50 million homes through charity. That's never going to work. It has to attract market-related capital and market-related returns in such a way that meets the needs of capital. And that is around information, pricing, and liquidity. And that's what the platform does. By linking the two, it provides that mechanism to attract capital into the space.
It's an interesting paradox in a way, because the traditional banking model will rely on historical data. If you go and apply for mortgage finance, they're going to look at your track record. How have you performed over the last number of years? Do you appear, are you blacklisted on any of the credit bureaus? And that, of course, can deny you access to funding completely. The way that you're approaching it is there is no history. What you're looking for is, how does that portfolio perform from this day forward? So it's very much a present time type of thing, and it's going to roll from one month to the next, and you're going to develop this very rich body of data on the blockchain that anybody can expect. And maybe just talk about that, and how do these portfolios perform, and are they ring-fenced, these different developments, from each other?
So what we're finding is that this market segment, there is a perception around this market segment that they don't pay. Okay, poor people don't pay. And that perception is fundamentally flawed. That data, whether you look at even at a national level, if you look at African debt versus international debt, African debt is one of the best performing debts, and yet it has this high premium because it is perceived as risky. It's exactly the same in this space. This segment of the market is perceived as highly risky, and therefore there's a significant premium to invest into this space. The data is starting to demonstrate, and we knew this intuitively, because if you work in this space, you know that this is how it works. You know that people pay. You know that if they don't pay, they move out and there's somebody else. Because of the pent-up demand, there's significant demand for housing stock. And it costs a lot of money to be poor. This is the irony. This is the absolute paradox of our financial system as it currently stands, is that there's this perceived risk which makes it incredibly expensive to be poor. So yes, the flexibility, we need flexibility in the systems. That is vitally important for the consumer. But the issue is how do we manage that risk, as you say, in terms of structuring that? And that's around the pipeline of potential tenants and building that information and data as you go forward. So to your point around historical data, that's one of the reasons why it appears to be stuck. Because everybody goes, we need data. We can't provide housing without data. But the approach that we're taking is to say, let's take a unsecured lending or startup model. Start small. Demonstrate success, scale it, and support the developers who perform well. That's the process by which you do it. So then you're looking far more forward-looking just like unsecured lending. If we had spoken a couple of decades back about lending to people with no collateral, people would say, you're mad. There's no business case for that. Yet look at Capitec today. That's the business model that Capitec took on and demonstrated for this market how significantly well that can work. So it's exactly the same in housing. It's just provide the flexibility. People do and will pay. We just need to build that data going forward. We can't go back because it doesn't exist. So there's no point in trying to pretend or trying to say, oh, we need data, or we will build data, and from the data, we'll be able to do this. We can't. So we have to be forward-looking. And we have to say, okay, forward-looking means risk because we don't have data. How do we build that data? Start small, build on success just as we would in any other startup or unsecured lending environment. Start small, build data, and leverage and build on success.
So maybe just to expand on that, give us an idea of the default rate that you have experienced. I mean, if you look at the banks, they typically show, and this is from memory, about 3% of their mortgage borrowers are in some form of distress. Is that kind of the ballpark area for you, or have you got a different experience altogether?
Well, you see, it's a different model because we're doing it on an installment sale, effectively. The mechanism is you have the stock. So the stock is not transferred until such stage as it's paid off. So if the tenant structure, the installment sales structure, or the self-build, we don't have terminology. That's part of we don't yet have language to describe this because everybody understands how a mortgage works, but people don't yet understand how this process works. And that's part of the challenge. But if you can imagine, it's a rental contract. So if somebody doesn't pay, they have a deposit, which you utilize, and they have a part payment. So in other words, the flexibility is enabled through the part payment process. So in other words, that self-build contribution and the deposit. So if they start getting into that space where they're eating into the deposit and not paying, it's a tenant agreement. They moved out and somebody else has moved in. So there's movement. There's more movement than would be a normal case, but your risks again are reduced. So again, this is around how do we manage risk, not how do we, exactly that. The questions are always based on mortgages. So we have a 3% default with mortgage. What's our default rate? Well, to date, we don't have a more default because we just move somebody out and move somebody else in. Does that mean people continue to pay? No, but it's the same. There's always within a rental stock that you have. There's turnover. So there's that kind of mechanism. And obviously in the planning, you plan for that. But that's how the process works. So at the end of the day, you still have the asset if it's not paid off. So you lose nothing and from a risk perspective. So that's the issue around that. And that's why I talked about the sort of continuum between rental and ownership. So, if you're creating a portfolio, an investment stock of rental stock, or you're creating a portfolio of stock to sell, this falls in between. And the process around that is that these tenants are better tenants because they have a vested interest in making this work. So again, you find the quality of tenant is significantly improved. And what we've found is that the tenant, once they have this opportunity, they know, just like everybody wants to own their own home. If you're given this opportunity to own your home, you will bust a gut to get it to work because you know that if this doesn't work for you, then you're really off the list. But so we find that people, the payouts or the behavior is significantly better than you would actually get in a traditional environment because of the incentive for ownership and the potential to own, the opportunity.
Yeah, I mean, I think with the traditional mortgage model, there's a sort of built-in flaw in that it's the duration of these agreements, 20-year or 30-year mortgages. You are going to certainly hit some sort of financial trouble in that 20-year period, and you're going to struggle. A lot of people do to make the monthly payments. Now, what you're describing there is a kind of the rent-to-own or the installment sale model, there is a lot of flexibility, and there is a deposit that is put in there. So I guess that gives you a degree of flexibility. I'm curious to find out how investors look at this, and are you getting them to bite, and are you getting them to buy into this from a purely market perspective?
Yes. As I said at the start, unfortunately, it's taken longer. When you're in the business and you see and know the stuff intuitively, it's easy. For us, we go, oh, don't you understand? It makes complete sense and it works. But the challenge for us is, I mentioned earlier, is we're competing against 100 years of data. So that's our challenge, is that we need more data. Everybody, when we've got data from one country, they say, but you haven't got data from our country. The investors go, yeah, but this market is different. People behave differently. And to a certain extent, that is completely valid. Every project, every market segment is different. However, the principles remain the same. So to that point it's how do we de-risk it? How do we create those returns? And how do we create the mechanisms that we discussed earlier, liquidity, etc.? So we are finding interest is definitely building. And so we're actually finding two ways of distributing the capital now. So we've spoken to a lot of the banks, and we find that the banks nod and say, fantastic. But actually, when it comes to implementation, again, it goes back to, we need a credit committee. And you go, well, you have to think differently in this environment. And that's very uncomfortable. So it becomes very challenging for most banks. So the mechanism that we're utilizing is to say the distribution model actually needs to be through the developer, if you like, the offtake, and creating a portfolio of asset-based stock by funding either the developer directly or by building mechanisms to hold that stock and to manage that stock. That on that basis, we're finding a lot more interest. So the distribution through development institutions to support developers, where developers are struggling. And so CAF, the Center for Affordable Housing Finance, refers to it as the massive small. You mentioned our million homes. The reason we call the company Empower is because we've known we're not going to address this by large projects. The way we're going to address the million homes is by supporting the smaller developers be able to support them to get 1, 2, 5, 10 units. That's the way we're going to build the numbers in this space. That's the way we're going to be able to do it. In the South African context, the township environment, how do we support the township developers to create this mechanism? That's the key part around building the success. So we're finding that some of the development banks are really keen on that model to support the emerging entrepreneur, the emerging developer, to give them the skills and resources. And this provides them a mechanism to manage that, to provide an offtake mechanism that supports that. And as I said, to build the data to demonstrate the success. So if you start at one $10,000 unit with one developer, see how they perform, then you can then scale it up to the next one. It's that process. Obviously, the challenge with that is economies of scale. That's a separate issue. But the real issue is around getting it to support that massive small in being able to do that. So that's the one distribution mechanism. And the other is we're working with the Nairobi Securities Exchange to create listable instruments that enable this, so that there can be direct investment from pension funds, etc., can invest into this. So they have a longer term view, obviously. But again, the challenge is they don't want to be stuck into non-performing loans or non-performing projects. And so this is where the mechanism comes in. And the opportunity exists for, if they are distressed, obviously down the line, our hope is that then there'll be players who will come in and manage these kinds of things and turn them around and create value. So that's the mechanism that we need, and the ecosystem that we need to build to support to create this kind of investable infrastructure into this environment that is currently not being met by the financial structures as they currently stand.
Right. So just give us an idea of the countries that you're in, and what is the development pipeline looking like?
It we're in 9 countries across Africa now. But we're particularly active in Kenya, Nigeria, and Mozambique. And we started in Mozambique as one of the really challenging environments because we wanted to prove that it's not poverty. If we'd started in Kenya or South Africa, people would say, but they're unique cases. There's money in those countries. Mozambique, there isn't money. And yet we managed to demonstrate that people still pay. So, and to your point, you mentioned earlier around the 20 years and the payments. In Mozambique, our research showed that 40% of the customers had a financial event in the first 12 months. So exactly that. When you're operating at that level, when you're operating on that, you have very little margin for error. And yet, people have to live, pay rent, do the things that they do. That's life. And so despite the fact that 40% had those payment issues, we still found that there was 95% payment. So people still live somewhere. And they will always, they have to try and make plans and flexible. And that's one of the greatest things around this market is the resilience of it is misunderstood. It goes, yes, you can't keep it 20, pay regularly for 20 years. And Kieran, I wish you could see the payment profiles of these customers. Every single one is unique. There isn't one that is the same because people pay that self-build mechanism. People pay, save, do what they can when they can. And that payment profile, that investment into their property happens completely intermittently and variably. And there isn't and that's the joy of the data. And as we build that data and demonstrate that, we are able to demonstrate, more broadly around the pipeline. So we're finding the pipeline now is growing, is really starting to grow. As I said in the beginning, now the institutional markets are really starting to get interested in what we're doing. And when we started, there was a great resistance to blockchain, and people didn't really understand what we were doing. As it's progressed, as blockchain has become more acceptable as a technology, and as people understanding the flexibility of what it provides, we're finding more and more the larger players are starting to really understand it. So in the countries, in Nigeria, Kenya, and Mozambique, we're finding now that there's significant capital pools that are starting to talk. And they're starting to say, okay, can you prove this? If you can prove this, we'll start to allocate more funding to you. And that's the process by which it's working. So we're finding in Mozambique, it's through development financial institutions. So it's through the DFIs. In Kenya, it's through the stock exchange, and and in Nigeria, we're actually working with the cooperatives. So there we're setting the initial funding through them because the banks and other mechanisms are very challenging. So we're working with the co-ops, and they're providing us with the initial supply of capital and data for us to start building that process. And so those are the 3. And again, it's one of those things around we need flexibility in different markets, but the principles remain the same. And that's the key part around it.
Just very quickly, finally, there is a token, the Empower token. Explain how that fits into this whole puzzle. Is that how you are collateralizing the lending that these institutions are making?
So yeah, it's a great question, Kieran, and it's one of the challenges that we've had again in explaining what we do. So we use the token, correct, to collateralize the first loss. So it's the first loss is one of the greatest things in this kind of environment. Excuse me, because the chances of you losing when you have an asset backing, particularly in housing, particularly in low-cost housing, particularly in markets where there's just such significant pent-up demand, the chances of you actually losing are not great. But there's a chance that there might be some element of flexibility in that return. And so really what we're saying is, if we can align everybody's interests in the ecosystem, if we can align the value that is being created in this ecosystem through developers, through investors, through ourselves as technology providers, by providing an ecosystem, an alternative financial ecosystem into this space, we are creating value. So by that mechanism, and if you think about Bitcoin as a good example of a community that is creating value by aligned interests, there's nobody promoting it, there's nobody putting it out there, and yet it's creating this significant value just by aligning interests. And that's what we're doing within Empower. So we're utilizing the token as a mechanism to align interests and provide first loss collateral through a digital asset. Where we're also seeking to get to is through the digital ownership of assets. We're not there yet. But if you can think about it, if you part own your house, that is significantly better. So if the representation of that house as an asset, the digital asset that represents it, you can part own it. And that then enables the mechanism, because people often say, if it's rent to own, what happens if you can't pay? If there is default, if there is a mechanism, and I've paid off 30% of my property, now what? So what that will enable us to do is to automate that process that you can own 30% of your home if you paid for it. And then you can, if somebody buys it, then you can proportion it accordingly, etc. So that process, we're not there yet, but we're building towards that it becomes a shared digital asset representing the underlying physical asset, and that income stream then could be allocated 30-70 or whatever it is on that basis going forward. So that we're really trying to share the wealth that is created through this mechanism. That's the key part around this. It's around, historically, we've sucked value out of communities because, it's by centralization. That's what we've done. So that's why you get, the bankers live in posh houses and the communities doesn't. And that's why what we're seeking to change and to shift is to say we need to create mechanisms that create the wealth for those people in the community, that their asset, no matter what they've paid off of their asset, it remains their asset. So they don't lose by that portion.
What a fascinating business model. I really wish you the best of luck with this, and I'd be very curious to see in a few months how this is progressing across the continent. It really brings some fresh energy and thinking to this massive problem that we're facing across Africa, 50 million homes, and how do we tackle that? I want to thank you very much, Glenn Jordan, for joining us on the Moneyweb Crypto Podcast.
Kieran, great to be here. Thanks very much for your time. I appreciate it.
Thanks for listening to the Moneyweb Crypto Podcast, hosted by Kieran Ryan. To listen to our other podcasts, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates.